On the Barron's Roundtable, my colleagues Ben Levison, Carleton English, and Al Root. So, Ben, it's a funny, contradictory market out there, has been for a long time. Pessimists say, oh my gosh, inflation was recently the highest in 40 years. And then the optimists say, yeah, but the unemployment rate is lower than it's been in 50 years. How do you make sense of it?
Well, Jack, you're not the only one that's confused by this. I think the market itself is. If you look at it, what it's done, it fell 0.3% this week. And it's actually moved less than 1% in either direction over the last 6 weeks. And it hasn't done that since 2019. And if you look back over those 6 weeks, the market has actually gone up just 0.4%, and that's the smallest 6-week move since 2021. And so I think this is just a reflection of all these forces pulling at the market. One that I was looking at was the jobless claims data. If you look at the big jump we've had this year, it would suggest that there's a recession coming. The only problem is if you dig into those numbers, you see that the state of Massachusetts is actually responsible for about half of that jump, and no one's quite sure why. They think the numbers might be a little funky there, and if you take those out, or at least adjust for them, things actually look okay. And so I think that's what's going on right now, is that you just have this push-pull going on between the bulls and the bears, and it's a stalemate.
Yeah, and I think especially on that bulls and bears push, I mean, you're especially seeing it in the banking sector right now. A lot of the concerns over regional banks have continued down about 1% so far this week, even though we did have the bailout of First Republic 2 weeks ago, but still questions about PacWest and a handful of other names in the space.
So, Ben, you've been bearish. What would be the argument that says actually things are going to be okay?
Well, I'm a big believer in looking at the market and what it's trying to tell us and how it's reacted in the past. And one of the things that we've seen is that when the Fed pauses, the S&P 500 has gained about 16.9% over the following 12 months. The other thing that's happening is that inflation has been dropping. And what we've seen there is that when inflation drops by 5 percentage points over the past 12 months, it goes on to gain about 14.9% over the next 12 months. So both these figures would suggest that there is perhaps upside ahead.
Potentially promising. No upside, at least this past week, for Disney. Carleton stock was down 9%. What happened?
Yeah, 9%. So Disney is facing the same problem that a lot of people in the streaming space are, where they saw a decline in subscribers, about 4 million. Wall Street was expecting actually a 2 million gain in subscribers. Maybe we're overstreamed. I don't know what it is. Now, a lot of that loss has to do with the fact that Disney lost its rights to cricket, which was actually an expensive endeavor for them to get those rights, but a lot of users in India abandoned the service from there. But basically, just looking at Disney, people were hoping that streaming would be a better business. Like Netflix, finding out it is a challenge. People are going out more. So during the pandemic, people were happy to sit at home and subscribe to 5 or 6 different places. Now we're being a lot more choosy.
Yeah, we've been saying for a while that at some point people were going to say that's enough, no mas on all the streaming services. Real quick, the Disney versus DeSantis fight, do investors need to worry about that?
I think with that, you're going to get a lot of headline risk in the near term. I think longer term, it's tough to bet against Disney. They will figure out the streaming game eventually. Also, parks continue to be upside for them, at least right now. Maybe a little bit of choppiness in the back half of the year. But again, long term, very tough to go against Disney.
All right, and that makes sense. Inflation numbers show travel and leisure up, goods down. Al, so tell me about mortgages. Twice as high as they were at the low just 2 years ago, and yet the housing market seems resilient.
Yeah, housing prices off about 7% from their peak, but like you say, you'd expect it to be doing worse. I think one of the missing reasons, the secret reasons, inventories are terrible. There's no inventory on the house. Before the pandemic, 1.2 million houses listed in the U.S. Now we're below 600,000 and we're dropping. So you just can't find a house. And then if you're in your 2% mortgage, you feel stuck. So that is keeping the housing market maybe more resilient. And also it probably will turn into a problem for the Fed.
It does make sense. If you're only paying 2%, why would you want to trade somewhere else and have to pay 6%? Mm-hmm. Why does this make it so difficult for the Federal Reserve?
Well, the inflation data from shelter and housing tends to lag, and these things like doubling of mortgage rates will eventually feed into the numbers, and it'll make it tougher to pause.
Yeah, and I believe housing is about 30% of the inflation numbers. So even if prices were to go down in the real world, it wouldn't show up in the data for many months.
Right.
All righty.